I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get to the burning issues in private markets. Softbank's Vision Fund seeing losses, with its earnings raising alarms about lofty private market valuations. Plus, cash plowing into rental homes with a big bet on the future of housing. And we look at the intersection of private equity and sports as wealthy athletes seek the best advice on how to invest their millions. Let's get into some of these burning issues. With me, Bloomberg Sonali Basak, Sarah McBride, and Natalie Wong. Let's get started with you, Sonali. The great asset management roll-up continuing. Legg Mason, Franklin Resources this week discussing this and joining forces. Sonali, within the private investment world, are we seeing a similar type of consolidation?
We sure are, and it's $20 to $30 billion under management is a typical size deal that you see for people who are seeking sales because they want scale as well. So Morgan Stanley, for example, about a year or so ago, made an acquisition in the real estate sector. Interesting to keep on watching if they will do more. There's some much bigger firms, Deutsche Bank's asset manager, sub $1 trillion, huge real estate business. The question there is whether they would ever consider a merger or a sale, or whether they'll be a consolidator themselves.
So there's a question here of whether private asset managers need to consolidate among each other or are simply acquisition targets because of their high fees and revenue diversification for the big giants. Do you have a sense of which, or is it both?
It's definitely the latter. You definitely see a lot of private asset managers in very high demand with high valuations. Most of the mergers we've seen so far are in the Legg Mason universe, in the Franklin universe, where there's a lot of fee pressure on things that focus on mutual funds and equities. Even Legg Mason, only about 10% of their AUM right now, that's assets under management, are in private assets. And they see inflows into those strategies, whereas the equity businesses are more pressured.
Who's the most likely takeover candidate at this point?
Oh, goodness. Again, 20 to 50. It's not that exciting of a size, Lisa, if you think about it. It's the buyers that I find more interesting. So if UBS will do something, if Morgan Stanley, if Goldman Sachs will do something, will be interesting to watch.
Well, that brings us to Sarah. We got some more information about how Softbank's Vision Fund is faring when the tech company released earnings. So, Sarah, how significant were the losses in this fund?
Well, they were not good. $2 billion loss in value over the last 3 months at a time when the fund is now over 3 years old, and you'd be expecting to see things turning up a little bit, not going down at this point. So not great news for Softbank here.
All right, so what are the main weak spots here?
Well, the biggest known is obviously WeWork. The fund itself had invested over $4 billion in WeWork. That's less than the Softbank Group overall, but still it was just so high profile and such a disaster that that's the number one investment everybody associates with that firm now. Didn't help them that at the same time that WeWork was imploding, Uber, another high-profile investment, was not doing well. That share price is now actually back up a little bit, so that's one potential bright spot for the fund, but WeWork's future is still uncertain, and then they've just had a number of other little problem spots here and there.
Yeah, and certainly there's a huge question about what this means for the entirety of Silicon Valley, given how significant of an investor they have been there. Meanwhile, shifting gears a little bit to real estate, the ongoing pain in malls has led to a surge of redemption from property funds in the U.S. and Europe. Natalie, how substantial have the withdrawals been?
The withdrawals have been pretty substantial so far. According to our reports, we've seen a variety of pension funds all across the U.S. pull out or file for redemption from some of the largest traditional real estate funds across the country, one of them being UBS's flagship real estate fund, which has about $25 billion worth of assets. There's a redemption queue of about $7 billion right now, and it seems like that could grow, so it's quite significant.
So, Natalie, is this only in real estate funds that have concentrated investments in malls, or is it more broad-based?
The specific fund that we looked at so far, UBS, has a larger concentration when it comes to retail, specifically regional malls, which some of these funds and some of these investors cited as a potential concern to stay longer in, given the longer underperformance and the uncertain future of what retail looks like and what could happen to those malls. And so we're definitely seeing a lot of investors getting more weary and a little more conservative and wanting to perhaps shift their money towards other funds that have less of an exposure to regional malls.
Natalie, is there a feeling that the withdrawals will lead to forced sales and rapid devaluation of some of this property, or does it seem to be somewhat contained?
I think there's a big question out there because one of the interesting things with these redemption queues is the lines have gotten so long, especially for this specific fund, that a lot of these investors have to wait 2 to 3 years to get their hundreds of millions of dollars worth of cash back. And the question is, how will these funds be able to return the money to their investors? I mean, they can either bring in more investors and then, use those proceeds to pay out the existing ones, or they're going to have to sell off some of their assets. And while I'm sure a lot of them would like to offload their regional malls, the problem is there just aren't a lot of buyers out there that are willing to buy these individual malls. And so maybe they might have to sell off some of the more popular assets, but that could increase their allocation to these malls. So it's a question definitely that's up in the air and that a lot of people are looking at right now.
And a question I'm sure you'll be tracking closely in the weeks and months to come. Thank you so much to Natalie and all of our reporters. Sticking with real estate, a growing number of investment firms are targeting single-family rental homes as a lucrative bet, the latest being Amherst Holdings expanding its portfolio by buying Front Yard Residential. But there's a question kind of embedded here, which is, as more companies look to invest in these properties, are there big opportunities left? Joining us now, John Beecham, who is Chief Executive Officer of Turek Capital Partners. John, thank you so much for being here. So what is your perspective in terms of where there are opportunities left, given how crowded maybe this is getting?
Well, it may seem to be crowded at the surface, but really it's not. If you look at Amherst and the other institutional buyers of single-family rental properties, they comprise about 2.5% of the single-family rental properties in this country. So it's really not a story of the big institutions. It's really much more of a story of the small mom-and-pop investors who may own 1 home, 2 homes, 5 homes, and 10 homes. And that's the vast bulk of the single-family rental market. All
right, so which regions are you still seeing opportunities to buy single-family home rentals?
Well, on the rental side, we see a lot of opportunity, especially in the South, Midwest, some parts of the Southwest. Less opportunity from a rental standpoint on the West Coast and in the higher tax Northeast states. But certainly in those areas, there's a lot of opportunity.
One thing that you're involved in is the whole fix and flip loan. Can you explain what this is and why you view this as an opportunity?
Sure. Well, we are the largest capital provider to the fix and flip industry in the United States. So what we do is we partner with lenders across the United States who make loans to our credit standards. These are loans that are basically for the purpose of buying, rehabbing and selling, or sometimes refinancing and leasing up single-family homes across the United States.
What kind of returns do you see on these?
Well, typical loans are averaging 9.5% interest rates. For the investors themselves, oftentimes in many markets, they can buy and sell a property and make 20, 30% returns on the property sale.
Are the potential returns shrinking given how much home values have gone up and given the affordability issues that people cite?
We've seen a big change in this market over the past 5 years. If you look at what was happening 5 years ago, people were buying what we would call paint and carpet deals, where you're buying a property, putting a relatively low amount of work into it, and selling that property. Those deals still exist, but they're a smaller portion of the business than they were just 4 or 5 years ago. So we're seeing the market shift towards people buying properties and adding value, adding another room, turning a single-family property into a multifamily property, expanding the property, and sort of changing the nature of the type of deals that are happening.
There's a question after the 2008 crash. There was a theory before that home values would never go down, and the whole concept of flipping was predicated on that. How do you sort of bake the new reality into your assumption of the idea that home values can go down and there can be a disruption?
Absolutely. Well, we look at every single deal that we finance to make sure there's an embedded profit margin in that transaction. So on average, maybe someone's buying a $200,000 house in Cleveland, Ohio. They're putting $50,000 of work into that transaction, and they're selling for $325,000. So there's a lot of room for values to go down before that loan ultimately comes bad. For us, we're a lender, or we're ultimately buying loans. So our average loan to value is about 65%. So there's a pretty significant cushion between what the expected profit is in that transaction and ultimately where a loan attaches.
How far away are we from a more significant downturn in the housing market? Perhaps not akin to what we saw before, but just where you see values plateau and decline?
I think generally, and there's 50, probably maybe even 500 answers to that across the United States, because real estate's a very market-specific answer. But across the U.S., we see a long time we've underinvested in our housing stock. We haven't built new housing in this country in a very long period of time, certainly not the rate of population growth. Interest rates are low, mortgage rates are very low, and they aren't increasing right now. And employment is high. So all those three factors mean that we feel pretty good over the course of 2020 with regard to the housing market and don't see a major correction happening in the near future.
John Beecham, thank you so much for being with us, Chief Executive Officer of Turek Partners. Coming up, this week's Power Player, a return appearance for Randy Schwimmer, Churchill Asset Management, Head of Capital Markets. We dig into the arms race in private credit. That's next. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. The theme of the moment is market share consolidation. We're seeing this in every corner. Corporate America among the biggest asset managers and increasingly in the private credit market. Randy Schwimmer is head of capital markets at Churchill Asset Management, and he characterizes it as an arms race. He joins us now. You talk about the arms race within private credit, the sort of race to get enough share on all levels of the lending world that you can be able to go without the banks, right?
Absolutely.
Can you explain?
Yeah, and it's actually why our combination that we just announced in January, where our Nuveen junior capital business is part of now reporting up to the Churchill senior business.
How convenient.
Very convenient. So we have like 22 billion of capacity. And that's really combining both scale and relationships. So you talk about the arms race, and what really, and you on the show have done a lot of, is talking about how private credit is actually tried to disintermediate the syndicated market. And with scale such as the 22 billion we have the ability to go to our sponsors and say, you don't have to go the syndicated route. We can take care of a senior debt and a junior capital deal for you by ourselves.
What's the tipping point, though, when scale becomes a liability in terms of getting so big that you have to take big concentrated risk in order to deploy your money quickly enough?
It's a great question. And so in our case, we spread out the risk amongst a number of different funds. So we diversify it by fund. And so no one fund has more than a very small percent. But there are some firms that don't have those multiple funds the way we do, and they're concentrating in one or two, and that is something to be concerned about.
Which brings us to another point that you recently highlighted in your newsletter, which is this sort of fear of the private credit markets and how much money has been raised. And you pointed to an institutional investor opinion piece where two investors wrote under the headline, high yield was oxy, private credit is fentanyl.
Yeah.
I imagine you disagree?
Yeah,
okay,
vehemently.
Okay.
And I had a rebuttal all ready to go, but there was a former Treasury official who actually did a rebuttal that was published, which was very good. And essentially, and look, capital markets observers always have to have something to complain about. In this case, though, it was really unfair because as the rebuttal pointed out, private credit is actually has nothing to do with systemic risk. These are practitioners who have long-dated capital, who eat what they cook, and the risk is not distributed out to somebody else. If we lose money, it's our investors and nobody else that suffers. And so I think private credit is actually a very honest way of investing in leveraged loans, unlike the way it's been done in the past.
Although you have seen a stripping away of covenants, you've also seen EBITDA add-backs or ways to inflate some of the balance sheets so that leverage ratios are actually somewhat higher than what we've seen in the past. Why is this not an area that people can point to as signs of froth within a market that has ballooned in the past few years?
Well, Lisa, that point is in fact the thing that we worry about, because when companies are supposed to get to a certain EBITDA level and they're not, their leverage goes from X to X plus. And so it's actually fake leverage because the EBITDA isn't where it's supposed to be. That's why, in our case, portfolio management is so important, and having a manager that has a track record over a long period of time through a recession and so forth, because we know what happens when you hit a recession, and so you try to build in those mechanics before you actually invest in the deal.
One reason why people have supported the high valuations that some people are arguing are prevalent within the private credit market is that private equity has so much money and is actually underneath them. So they're propping up values and they have a pretty big cushion. Right. Do you buy that? Yeah, in fact, in our portfolio, as an example, over 50% is the norm for equity cushion in each of our deals. And it's true. The thing that people do worry about is that what happens if the sponsor takes their money out of the deal, okay? So we're very concerned ourselves about dividends, as an example. And then you have to worry about what kind of business is it? Is it a cyclical business? So that 10 times multiple that the company, the sponsor paid for it today, what is it worth in a recession environment? So we tend to be more defensive in terms of the industries that we focus on. So constructive. There are pockets of concern, yes, but in general, moving toward an ongoing consolidation and normalization of the industry. I think private credit is still a great business to be in. I'm shocked. Randy Schwimmer, Churchill Asset Management, we always love having you on. Thank you so much for being with us. Coming up, more large family offices are getting direct access to trading desks. They're even hiring veteran institutional investors. What does this mean for big banks? We'll discuss that next. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Let's get to our billionaire beat. The number of private investment firms for the rich has surged over the past decade, and the largest family offices are increasingly bypassing private bankers to deal directly with trading desks. So much so that Citigroup and UBS are taking notice. Joining us from London, Bloomberg's Ben Stupples. Ben, so why exactly are UBS and Citigroup starting to deal directly with family offices?
Well, Lisa, it comes down to the fact that family offices are becoming increasingly sophisticated and, frankly, just having so much more money and buying power. And the biggest are there going to their private banks. I want to do this particular deal. And actually, the private bankers are there going, you know what, this is probably a transaction that's better placed for our investment bank. And it comes down to the fact that on that side of the bank, the family offices can benefit more from the really niche, narrow focus of the traders on the market desks. And that could be anything from equities to foreign exchange to simply actually the valuation of loans. So it's a real broad spectrum. And yeah, banks are indeed taking notice.
So Ben, who is the middleman that's getting cut out here?
I would say the middleman getting cut out, actually, if you think about it, it's the private banks. The private bankers are actually there going, this is actually something that isn't specifically for us. Of course, that's a benefit when you're a really big bank like Citigroup. They're a perfect example where they can actually incorporate their whole group within one deal to service one client. The real problem is when you're a smaller private bank and you haven't got the facilities of a big investment bank. So those are the ones who would be looking at what we've been reporting and thinking this might be a problem for us.
And Ben, this sort of raises a question about the infrastructure around family offices and sort of who they're hiring. How much are they looking increasingly like asset managers that are larger and more sophisticated?
I think certainly the biggest ones are hiring some really big talent from the institutional firms. And if you look at the top end of the market, Silicon Valley billionaires, I mean, they've been hiring some serious, hiring away from some of the big players for many years now. What we're seeing also in Europe, we're seeing that as well over here, increasing growth. And I'm sure with Asia, with the surge in growth that they're seeing over the past decade or so, that will also be the case over there as well.
Ben Stupples in London of Bloomberg. Thank you so much. Turning now to Trendsetter, a look at someone blazing a new path in private markets. This time, we look at Mark Patricof and the growing trend among professional athletes to be smarter with their money and to put their millions to work in a variety of different investments. Bloomberg's Eben Novy-Williams recently spoke with Patricof, and he joins me now. Eben, I'm so glad you're here. It's sort of interesting to me, this transformation, how athletes use their wealth. Can you give us a sense of how much this has changed?
Yeah, no question. There was a long time where athletes, if you were good enough, what you wanted was a big endorsement check from a company to be, in their commercials or in their advertisements. And if you were really lucky, if you were Michael Jordan, maybe they would build a separate kind of co-brand around who you were. Now we're seeing athletes of all sorts realizing that instead of the endorsement check, there might be more money if you invest in the underlying infrastructure, right? Instead of doing a deal with McDonald's, you do a deal with Ant Pizza, as LeBron James did, for example. So they want to get involved in the underlying infrastructure because there's more money there and they're understanding that for the first time.
So what's Mark Patrikoff doing?
Yeah, so one of the things he does so well, he works with a number of athletes. He is telling them, listen, when you are playing, this is the time to think about this. The time isn't after you're done playing. The time is when you have, social equity as a player. So one of the things he does, which I think is so smart, he gives guys a packet when they're on the road. So if you're an NBA player and you're playing in Portland, here are the biggest business leaders in Portland. Here's who you can sit down with when you have an off day before or after or the morning of your game, right? So he's telling his guys, when you go around, you're traveling all over, people want to meet, business leaders want to meet with you, you have a lot of money. Maybe take that time and sit down with the people in those cities, whether it's the owner of the opposing team, as Grant Hill did for so long, and that worked out very well for him. Mark is trying to educate these people that now is the time to think about it, not when you're done playing.
Are you seeing also or hearing about private equity firms or other sort of alternative asset managers market directly to the athletes?
Without question, yeah. I mean, these are guys that have a lot of money, and as I said, they're starting to get savvier about the kinds of things they want to invest in. So media is another great example, right? The number of professional athletes right now who have their own media companies is huge because they recognize that fans want access to the content that they have, not just on the court or on the field, but their lifestyle. And in the past, they would have given that away for a lot less money. Now they realize, hey, if I own my own media company, I can put together this documentary. I can go to HBO and say, listen, why don't you put together a show around us, use my media company, and we'll do it together. That's the kind of deals that athletes want to cut now.
And increasingly, they're being a lot more involved in every investment that they make, correct?
Without question, yeah. And we talked a lot about this in the last couple of weeks with Kobe Bryant, right, who was one of the first athletes to really pioneer maybe this new wave of thinking. But yes, they're being much more hands-on. They're thinking about it at an early age, and that's great for the folks who are around them trying to get involved as well.
Evan Nova-Williams of Bloomberg, thank you so much. And speaking of big money, it's time for this week's big number. It is $10 billion. That is the amount that Amazon's founder and the world's richest person, Jeff Bezos, is putting in to start the Bezos Earth Fund. It is his biggest ever philanthropic investment to help counter the effects of climate change. Does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. This is Bloomberg.